Dear students, I'm working on cash management, and this is what this video will be all about: how to manage your cash in a good way. Sometimes you can hide it in a book, and that way you know that your kids can't find it, because if you have it in your wallet, it's not well managed, because your kids will find their way to your wallet and say, hey, you didn't pay me for that lawn mowing service that I provided you, and grab it from there. But they will never know what book I hide my cash in. So in this video, I will cover more about how to manage your cash better. See ya! This video will cover cash management. In corporate cash management, also known as treasury management, business managers, corporate treasurers, and chief financial officers are typically the main individuals responsible for overall cash management strategies, cash-related responsibilities, and stability analysis. They're responsible to track every deposit made through a very sophisticated advanced digital deposit ticket system, sometimes as simple as looking at statements. Make sure that all these things are done accurate, focus on decreasing costs, and eliminate errors. Everything typically has to be a real-time reporting. For international finance, cash management means the services that allow companies to realize cost benefits across border lines, currencies, and payment types. Every organization is different when it comes to cash management, but typically the questions are the same. What are the amounts of cash balances that we have? What banks or bank accounts are the money located in? What currency do we currently have money in? Where are these cash balances located? Sometimes it's not in the same country. What is the cost of keeping too much cash on hand? A lot of financial ratios also consider how much cash you have on hand, and if the money's not working for the business, that might mean that the ratios end up being low. What's the variability of cash flows? What's account payable and account receivable? How many days are those? What kind of cash strategies do we have in regard to different currencies? Should the company have a centralized cash management in the home country? Or should we outsource the cash management to each local region? Where can the company borrow money at the lowest cost? And where is the return or the returns the highest? Most of these things don't change on a day-to-day basis, but these are questions that need to be asked as things change in the world of economics. Anytime a major thing changes, like interest rates and other risks, it might change how you decide where to have your cash. The consistent work has to do with how to maximize the returns on working capital. How can we be efficient? Can we be too efficient? What is the value of a rainy day fund? And so on. This graph explains the cost in dollars of holding cash on the y-axis, and on the x part here, the horizontal, is the size of cash balance. So here we have a little part where we're trying to figure out the total cost of cash. And there's trading costs, and trading costs increase when the firm must sell securities to meet cash needs. And then here we have the opportunity cost, which is the investment income that we forgo when we hold cash. Cash is always good on the sidelines to take advantage of opportunities that arise, especially if you're like a fund manager and you're trading the stocks on Wall Street. But when it comes on the corporate side of things, where you're trying to figure out, should I buy more inventory now or should I buy it later? That's a totally different question. And that's where a lot of the work goes into. What is the amount of working capital that we need to be able to keep the business running efficiently? Now we'll look at multilateral netting, which has to do with keeping the transaction cost of moving money from one place to another low and efficient. This part really looks at how internal costs are allocated. Sometimes it's called internal accounting. So multilateral netting is an efficient and cost-effective mechanism for settling internal affiliate foreign exchange transactions. Now, it's important to know that not all countries allow multinational corporations to net payments. So by limiting netting, more unnecessary foreign exchange transaction flows through the organization and the local banking system will occur, so you can actually control it. So here's an example of a U.S. Multinational corporation with three companies in different parts of the world. One in Canada, one in England, and one in Germany. So here we can see a bunch of cash flows that are going back and forth. So $20 is actually, in the thousands. So, but I'm going to say $20 in this case. $20 is going to Canada, and $30 is going from Canada back to the United States, and then you have $40 flowing to England, and England is shipping $60 back to the United States, and Germany is sending the United States $35, where the United States is sending Germany $10. And all these transactions will cost a lot of money if we would actually pay for the all of this to be done. So that means that there's a fee for sending the money between the United States and Canada and England and so on. And that is a way of making it more expensive than it actually has to be done. There must be a better way. Well, we're going to learn that right now. So by simplifying the netting, Canada will simply just send the United States $10. Germany will send the United States $25, and England will send the United States $20. So that's just a simple way of just looking at the netting of how much money should flow. Now, can we make this more efficient? Of course we can. So if we keep it really simple, Canada needs to send the United States $15 and England needs to send the United States $40. That's just two transactions. And that's how the company can manage its internal affairs more efficiently, and it will save lots of money. But wait, there's more ways of doing it. We can actually have netting with a central depository. Some firms use a central depository as a cash pool to facilitate the fund's mobilization and reduce the chance of misallocating funds. That means that all the money flows into the central account, and then funds are allocated as needed. So here's an example of the accounting when you net with a central depository. Consider the net cash flows of the affiliates with the rest of the world. Here's an example where you have the net receipts from multilateral netting, where the United States gets 55,000, Canada 15, Germany gets nothing, the UK gets 40. Okay, actually this is a negative outflow, so this money here flows into the 55. And compare that to net excess cash from transactions with third parties. So in this case, the United States should be receiving 20, and Canada is paying out 30, Germany is receiving 75, and the UK is paying out 25. When you compare the net flows of everything will look a little bit different, and we'll take a look at a picture that makes it easier to understand. In this case, Germany is then sending the 75,000 to the central depository. England is sending 15,000 to the central account, and Canada is in this case receiving 15, and the United States is receiving 35. A different way of seeing this is that they have a joint piggy bank, and it controls who gets what kind of funding to pay for their expenses internally. Some organizations choose to have a transfer price or a transfer cost. It can sometimes seem controversial even for a domestic firm. Consider the example of a firm that has one division that mills lumber and another that makes furniture. The transfer price of the lumber is a political as well as economic and accounting issue. For a multinational corporation, there exists the added complication of different tax rates, different duties and quotas, exchange rate restrictions, and even the IRS tax code in the United States requires reasonable transfer prices. That is what they call arm's length. It is defined as a price that is a willing seller will charge a willing unrelated buyer. It is a way to make sure that the company is using its scarce resources really good, even if it is the internal resources. Another example might be internal communication, where if their services were given out for free for all the divisions, they might all fight over who's going to use this extra labor for free. Now, that means that the quality of the communication might not be quite there. But if a division has to pay for communication consulting, for example, the communication person will come in and help them structure a message and then indirectly bill them for the hours as they use the scarce resource. That helps with the budgeting, how much money should be allocated for the communication department in this case. If the demand is very high, then more money would flow into the communication department, and they might need to hire more people using this budget. If the demand is low, then the budget for the communication department might slim down and cause them to actually need to lay off people. This is just one way of how you deal with accounting on an internal basis. So understanding the transfer prices or cost, also sometimes referred to cost allocation, is a process of providing relief to shared service organizations' costs and the centers that are providing these services or products. In turn, the associated expense is assigned to the internal client's cost centers. The reason for all of this is that today's organizations face a very strong growing pressure to control costs and enable responsible financial management of all the resources. Dear students, I hope you liked this video. If you did, please subscribe by clicking up here and give me and maybe even write a little comment down below. So I appreciate your help and your support, and I hope you enjoy these videos on finance.